Alright, what's going on everyone? Welcome back to my channel called Investing Sucks. We talk about the part of investing that sucks, and today we're going to be discussing a pretty big company in Canada, which is where I'm from, and it's called Shopify. Now, the reason I kind of want to talk about this company is because they've been getting a lot of hype recently, right? This is a very growth-oriented company that has a lot of investors excited, a lot of people making bold claims about their future. So the whole point of this video is to kind of just talk about their fundamentals, talk about this actual growth potential that everyone is saying they have, and then try and put it into perspective from a value investing standpoint. Now, I consider myself a value investor. Now, you may think this guy's going to hate this company because it's a growth company, right? He's going to point at the PE ratio being too high and all this other stuff, and that's not necessarily the case, okay? I'm going to give you a very unbiased viewpoint of this company. Now, you may also be asking, why does this guy just have a whiteboard? Why doesn't he have Excel sheets and 10K reports and all this other stuff, research reports open, and talking about this company more in depth? Well, I like to keep investing simple, and I think that if you can't really explain your investment thesis using a simple whiteboard or just a piece of paper, then you probably need to do more research and really think about what it is you're trying to invest in. So without further ado, let's actually get into the video. So, Shopify. Now, as I'm recording this video, which is early June of 2021, they have a market cap of $150 billion. This is up a lot from previous years. Obviously, it was boosted because of, that thing that happened in 2020. So we're going to talk about that as well. But let's get into the fundamentals real quick. Now, a lot of growth investors may hate that I'm getting into fundamentals, but we have to discuss it, all right? Not just saying that their fundamentals are bad or good, but just putting into context, right? So PE ratio of about 95 as I'm recording this video. Obviously, that's quite high, right? Historical averages usually range in somewhere 15 to 20, but this is a growth company, right? We're willing to pay more for their growth. So a PE ratio of 95. Some growth investors may say ignore that altogether, just don't even look at it. But let's put it into context. Operating margin, I chose their operating margin to look at here instead of profit margin because they've had a lot of unrealized gains on their income statement, which kind of makes it all out of whack. Recently they had one company they invested in go public, which had a huge unrealized gain. So operating margin of 10.5%, this was up 12% in Q1 of 2021. So that's what we like to see. They are really a software business, right? So they're going to have pretty good operating margins into the future. Now, they have said that in the near term, because they're focusing on offering more merchant type solutions to their businesses, this may not grow as much as some people might expect. That's what Shopify's management said. So in terms of that, it's hard to understand what to expect for that, but it is a software business. If we're looking long term, we expect that to go up. Revenue growth, revenue's grown significantly. It was $390 million in 2016 and $2.9 billion in 2020. And year over year, it's up 100%, obviously because of that thing that happened. And they were first profitable in 2020, so they've only recently become profitable. But them being a high growth tech company, the fact that they are profitable is interesting, right? Because not many of those companies end up being that profitable. Number of shares outstanding. So this is something you have to pay attention to because they're always increasing their amount of shares. They've been doing it quite a lot, actually. 84 million shares outstanding in 2016, 120 million in 2020. You as an investor want shares to be going down, ideally. Now, shares going up isn't always a bad thing, but putting it into context, it does mean that you as an investor are getting diluted because the more shares they're issuing, the more earnings need to be shared with all the other shareholders. And they also have employee stock option plans. So even if they stop issuing shares altogether, there's still those employee stock option plans that are going to dilute you just a little bit. So that's something to keep in mind. Now, just a quick overview of their balance sheet. Current assets of $8.5 billion. Current liabilities of $495 million, which gives them a current ratio of 18. Now, usually with current ratios, anything above 2 is strong. Their current ratio is 18. So they have a very, very strong balance sheet. In fact, they have $2.8 billion in cash, and their total liabilities are $1.2 billion. So technically they have enough cash to pay off all their liabilities and then still have some left over. So that's a very strong balance sheet. They also have, this was as of Q1 2021, they also have $5 billion in marketable securities. Now this is really just additional cash. They're just investing this in securities with short-term maturities just to kind of earn a return on idle cash that they have. The reason it's so high though is because they are issuing a lot of shares, which makes sense. I mean, if you can raise capital at 95 times your earnings, why wouldn't you issue more shares, right? It's good to set yourself up now for the future with more cash. Free cash flow growth. Now, this obviously has grown year over year. It was $425 million in 2020. I also like to look at quality of earnings. So this is where I just compare net income to cash flow from operations. The reason I do this is because you want to know how much of their net income is, actual net income from having revenues higher than their expenses, or is it just accounting adjustments, basically. So comparing cash flow from operations to net income gives you a general sense of how that kind of works. So cash flow from operations was 425 million and net income was 320 million. So that's a pretty strong quality of earnings. It means their net income wasn't solely driven by accounting adjustments and whatnot. Okay, so they are a growth company. Let's actually talk about some of these growth prospects. So they have two main streams of revenue: subscription solutions, which is what they call them, and merchant solutions. So subscription solutions is their annual subscription fee that they offer to their partners, as they call them, or the merchants. So the businesses using their platform. So it ranges from a very low tier, which is if you're just kind of starting a t-shirt business or you want to like sell merchandise, for example. That's really what you're going after, to much higher tiers, which offer more services. They also have merchant solutions. So this is other stuff like shipping services, financing. They offer financing, payment processing, email marketing. There's a lot of stuff that they're offering. They do a lot of these side hustles, as you'll know, of coming up with new innovative ways to generate revenue. And their merchant solutions, as a percentage of their total revenue, if you look at it on a quarter by quarter basis, it is slowly increasing. So that's interesting. Now I would say that this company has a pretty strong economic moat, and this just comes from the integration of all these services that I talked about. They are quite unique, and some people would argue that they compete with Amazon in certain ways. Some people would say that they don't. They are a very unique company though, and that if you want to start a business, you could go to Shopify and they're going to offer you pretty much everything you need to start that business. Even if you're just some guy sitting at home and you want to start selling t-shirts, go to Shopify and they can set you up with everything you need. Even if you're a larger business, you want to sell cookies, they're going to give you everything you need and they're going to support you, which is pretty unique. Now, their revenue year over year was obviously quite boosted, right? They sell storefronts, right? They help companies set up storefronts. And it's an online storefront. So because of that thing that happened last year, the amount of revenue they got doubled year over year, which makes a lot of sense because companies were forced to move online. And the fact that the revenue went up so much really speaks to that economic moat, because if companies are going online, they're looking to Shopify. So that bodes well for their future growth prospects. So they have what I would call two pillars of growth that would fuel their growth into the future. So one is retail e-commerce growth. So as we know, businesses are moving online, right? Shopping is becoming increasingly done online rather than in person. Now that doesn't mean in-person shopping is going to go away altogether, but when Shopify offers services like their payment processing, that's pretty good for them because that enables them to earn more money as there's more gross merchandise sold using the Shopify platform. And then there's also growth in their total addressable market. So they're really an international company. They don't just sell in the US, although the US makes up about 60% of their revenue, something like that. They're selling in pretty much everywhere around the world. I believe there's 175 countries they have merchants in. So when we're talking about total addressable market, that's the total amount of customers they can sell to. So they're going to grow that by expanding their service offerings, expanding into new countries, which if you're looking for long-term growth, that's really good, because if they're just selling in North America, then their growth is inherently limited. Okay, so now what I'm going to do is we're going to try and make sense of this $150 billion market cap by projecting their EPS for the next 10 years, and then assuming a price to earnings multiple at the end of that 10-year period to project what their per share price should be, and then project what their actual market cap would be, and then see if those growth prospects do become true, how much is this company going to be worth? So these are going to be very high, projected growth rates, because they are a growth company, right? And that's really the whole point of this, is to try and make sense of how much people are paying now for future growth, and then see what type of returns we can get by investing in them if we assume different growth rates. So I'm going to go over two scenarios. But first, I should say their current EPS is 12.8. So this is as of their most recent quarterly filing. So 12.8 EPS. Now in scenario 1, we're going to assume that they grow 50% year over year, so 2021, which it's looking like that is a possibility. Then after that, we're going to assume 25% growth in EPS, by the way. So one One thing to keep in mind is that this is growth in EPS. If they issue more shares, which they probably will, and they still have stock option plans for their employees, which will further dilute shareholders, their actual earnings need to increase at a higher rate than this. This is just EPS growth, right? So if shares outstanding are also increasing, earnings need to increase even more to achieve these projected growth rates. And then we're going to assume 10% growth from basically 2024 to 2030. So a 10-year period, this is the projected growth. Now in EPS, if we calculate that out, which I've already done, we get an EPS of 66.4. Now, after all that, if we assume that they're selling for a 25 price to earnings ratio, so 25, we'll get the per share price, but on a market cap basis, it's 206 billion. So they'll be worth 206 billion in 10 years if they grow at those rates and then they have a price to earnings multiple of 25, which in 10 years, if they do grow at those rates, their price to earnings multiple has to kind of go down, right? Because as they achieve that future growth that people expect them to have, this price to earnings multiple is going to go down from 95, where it's at now, to something more reasonable when they become more mature, which should happen, that should develop over the next 10 years. So if they are worth 206 billion in 10 years, your average annual return is only going to be 3.2%. So even if they achieve these growth rates, remember growth in EPS, not just earnings, and then after a 10-year period, they're still selling for a 25 price to earnings multiple, which historically is quite high, that would still assume some future growth projected into the company, you get 3.2%. Now let's go over a more aggressive growth scenario. So I'm still going to assume 50% growth next year and 25% growth for the next 3 years. But from 2024 to 2030, we're going to assume 15% growth. Now, obviously, it's not going to be exactly like this. Their growth is going to change. It could go up 100% one year and then like 2%. You don't know. But this puts their valuation into context and allows you to understand, do I like this company, this growth company, at this valuation based on how realistic I think their future growth in EPS is. So with all that, they get an EPS, and we're also going to assume that they're selling for a 30% price to earnings multiple in the year 2030, which is quite aggressive still. So this gives them an EPS of 86.7, so we multiply that by 30. I don't know how well you can see this, but trust me. This gives them a market cap of 323 billion. 323 billion in 2030, assuming 30% PE and 86.7 EPS. Now your average annualized return over 10 years, if that becomes true, is 7.9%, which isn't bad because that's about historically what the whole stock market averages. But as a growth company, we're really looking for better returns, right? So even if all that comes true, you're still really only getting 7.9%. Now, that could be acceptable for a lot of people, but what the whole point of that exercise was is to put their growth into perspective. If you think that they're going to smash these growth perspectives, then by all means, pay 95 times earnings for them now. But if you think that this is aggressive, then you might want to wait a bit, see if their valuation comes down before you move on. So before I end this video, I just want to get into some rebuttals that some people may have. So you may say that if you take a value investing type approach, you're going to miss out on a lot of opportunities. You never would have invested in Google, Apple, Amazon, all those you would have missed out on, and Shopify is no different. Well, talking about Shopify specifically, they're $150 billion market cap, okay? Likely the money in this company has already been made. $150 billion is a big company. There's a lot of future growth already priced into that. That's something you need to understand. So yes, we like growing companies. Does that mean you pay whatever price it takes to get growing companies? No, it doesn't. And yes, they have an economic moat, so they are a strong company with strong growth prospects, right? But still put it into context, understand what you're paying for the value you're getting. Because, like I said, they have very lofty expectations at $150 billion market cap. Now, if someone from the future came to me and said, a month from now, say a month into the future, Shopify goes up 30%, I wouldn't be surprised, right? They fluctuate quite a lot. So then some people may come back to me and say, look at you were wrong. Look how much they went up in the next month. I'm taking a long-term approach here, guys, okay? I'm talking about 10 years into the future. I'm not talking about what happens next month or next year, all right? So yeah, like I said, just be patient with this company. Remember, $1 of earnings is $1 of earnings. All companies, when it comes to earnings, they may not be created equal because of growth, right? We want to pay more for future growth. But whether that growth comes from, Amazon, Pets.com, Tesla, whatever, $1 of earnings is still $1 of earnings. So that's something you have to keep in mind. So anyways, that's my thoughts on this company. Let me know what you think. Leave a comment if you're also interested in this company. And also, subscribe if you're new. I'm looking to hit 100 subscribers by the end of the year, so I'd really appreciate it if you would help me reach that goal. And with that in mind, thanks for listening, and I'll see you in the next one.